Welcome to another episode of the Mike Smith Investment Podcast. My name is Michael Smith. Today's episode, we're going to be talking about why most young investors fail. I'm 20 years old. I've only been investing for around 2 years now. I'm studying finance in college, but this is just some of the stuff that I'm kind of seeing around me. Primarily has to do with speculation. The main thing that I see a lot of kids my age do is kind of get into the day trading aspect of investing. It's really just emphasized by that get rich quick scheme. These people are flexing their fancy cars, their big houses through day trading, when in reality day trading really doesn't work. This article says 1 to 3% of day traders are actually able to outperform the market. Extremely low percentage. Most of the time, the people you see online are really able to make that money through the platforms and programs that they sell to other people. Along with that, with day trading, there's an extremely high turnover rate, so higher fees, higher taxes. You're buying and selling stocks a lot more than if you were to have a focused investment portfolio while participating in a long-term buying and holding of a security. People just want quick returns, but it really doesn't work that way. As I'll show you, the best thing to do is just stay patient and hold the investment for the long run. In recent years, though, there really has been more of an emphasis on shorter trades. Even professionals are doing it in order to get the highest winning portfolio. They're selling a lot more companies within a year, and like I already said, this just creates a lot higher fees and taxes, which really decreases your net return on investment. Allows me to go into my second point, that 90% of the trading in markets is done by professionals, and they make the market efficient. This is efficient market hypothesis, where investors really aren't able to outbeat the market. Now, it's important to note that Warren Buffett argues against this, and it is true that certain investors, if you follow a certain approach, you can outbeat the market. And in Warren Buffett's case, he's consistently outbeat the market through buying and holding for the long term. So it is possible, but if efficient market theory wasn't a thing, then everyone would make money because the stocks would, or companies, would continue to increase in price. But that's why the markets are so efficient. It's because that's not the case. So it is possible, but the reality is that most traders participate in speculation, which makes this theory even more relevant. So the next thing is bubbles. I see a lot of people trying to time the market. You can't time the market, as stated, through efficient market theory, which is a reality. Very hard, if impossible, to time the market, and a lot of people get into bubbles. Bubbles is when a stock price rapidly inflates in price to a level way above its intrinsic value, making it overvalued. So a lot of examples of bubbles: the housing bubble, the dot-com bubble. But I'll look at the dot-com bubble here. I'm looking at the NASDAQ 100 index. Huge peak and then a huge decline in price. A lot of people get in right here thinking that the stock price will continue to rise, but that's why the market's so efficient. The stock does not continue to rise, and people start selling rapidly, mostly firms that really control the market. I've seen bubbles in a lot of ways. Take Bitcoin, for example. Now, it's hard to really emphasize this point in the current graph of Bitcoin, but I think people just really get in at the wrong time. Truly, the best time to buy a stock is when it's declining in price. You get a discount, and you have a higher possibility of a higher return if you were to buy it at the peak. Now, don't get me wrong, you could still make money when buying a stock at the peak, but this is something that I struggled with early on was, buying companies that were extremely overvalued. I didn't really know how to properly value a company, and I'm still learning how to do so. But thinking that I could time the market is certainly not the case, and a lot of investors think they can too, such as why a lot of people get into day trading, which is highly speculated upon, and you just can't time the market. It certainly does not look that way. So, another thing that a lot of investors do is kind of overlook their analysis or overlook important analysis. A lot of investors don't properly have a set strategy that they follow. You can't just look at a company's financial statements and make a conclusion. It does not work that way. The best thing to do is fully read an annual report. If not fully read, skim through it. That's better than just looking at their financials. I try to read fully through the annual report. It gives me a lot of information on some of their initiatives that they're doing, what their future growth could entail, how their business operates. Because when you buy a company, really you are, or you should think of yourself as someone who now owns that business, who now helps run that business. In reality, your size in the company is very small compared to firms, depending how much you're putting in. But you should still see yourself as that because it helps you view a company through that business lens, which in turn helps you get a higher return on investment, which I've seen and learned. So it's important to fully read the annual reports. You can find the annual report for really any company by just looking in, say, Microsoft annual report or Nike annual report. It'll come up. And this will give you a ton of information, including all the financial statements, which are much more accurate than going on something like Yahoo and looking at a company's financial statements through that platform. Yes, fully read the annual reports. You can also get information from other investors, which could be useful, but take that with a grain of salt. See if you trust that investor. I wouldn't fully go in just looking at another investor's analysis on the company at all. I would do your own research. You could also get information, just any investor-related information released by the company can be super helpful in your full in-depth analysis. But really trying to emphasize that you do a full in-depth analysis, because one thing that I did in the beginning was just look at a company's financial statements, which that it could give you a lot of information on the health of the company. Something like Microsoft is such a big company that really you could just be fine with looking at the financial statements, but it's important to see yourself as someone who owns the business, like I said. So reading the annual report, getting a better inside look on the business is super important in a full depth analysis. Really trying to emphasize the full depth analysis. You can also set yourself a certain kind of checklist that you go through, but just having a set strategy really helps. But adding in an annual report, any other investor related content released by the company can really help you make a good conclusion on whether or not you should invest in the company. So overall, stick with the long-term approach. It works. Warren Buffett commonly says the best time to sell a security is never. In his case, that is true. Like I said, if you focus on a focus investment portfolio, which relates to only focusing on a few companies, could be more risky in holding them for a long time. You have lower fees and lower taxes than having a higher turnover rate in your portfolio, which means constantly taking out investments, which could increase your taxes and increase your fees. But Take the S&P, for example. If you were to invest 5 years ago and buy 2 shares of the company at a purchasing price of $3,319.81, you would have $5,000 profit. Not taking in any buy commission or any sell commission through your broker. And if we go even deeper back, 20 years ago, for 2 shares, you would have $9,000. So it clearly works when looking at the S&P. Maybe for other companies, you couldn't get this same return, but you have a lot better chance of holding the company in the long term than the short run, which is highly speculated upon and doesn't guarantee you as high of a return. So overall, that's some of the stuff that I see most investors my age do anyways. I'm 20, so still young in the field of investing, and I'm still learning more and more. I'm in college, so really just learn from the greats, Warren Buffett, Charlie Munger, and stick with a long-term approach. It works, and you would be a lot more profitable if you shied away from day trading and went and invested your money in the S&P. Maybe it's not as glamorous, definitely more long-term, but I will guarantee that you will most likely make money unless you're in that 1 to 3%, which is highly unlikely. And just trying to continue to learn. There's so much more information that I can learn every day. Reading really helps. Copying the investment styles of, say, Warren Buffett really isn't that bad of an idea. He's outbeat the market. But try to develop your own investment style. So that's all I have for today. Again, I am no means professional, and if you want professional advice, I would seek someone educated in the field. But that's just some of the stuff that I see kids my age do. I'm going to try to start posting 2 videos a week for you guys. I think I want to do kind of an overlook on my portfolio and maybe a little bit of a guide to my strategy that I use when analyzing stocks. So thank you guys for watching, and I'll see you next episode.